weeks, that locking up resources in the ground is a terrific idea. Locking up timber, agricultural land will do just fine. A great inflation hedge, you will win, in my opinion, very high probability, over a long horizon. Now, have these things gotten ahead of themselves in the short term? Quite possibly, yes. And that's what makes investing so tricky. If they were to break for whatever reason at all in the next year, I would suggest that is a great buying opportunity. To buy here is to trade off the long-term high prospects of winning with quite a reasonable chance of buying at a short-term peak.
So is there value in some of the commodities producers, the equities?
If they have stuff in the ground. If they're just processors, forget them, shoot them, in fact. Because they're the people who will pay the price of constantly having to raise their prices, paying more for their raw materials. But if they've got stuff in the ground, the oil industry since 2000 has doubled against the stock market. They didn't double because they got brilliant. They doubled because oil in the ground became worth 4 times what it was. And that is a wonderful thing for an oil company with good reserves. But the same if you had mineral reserves. That's the play, I think, on commodities.
It's extraordinary that people are putting so much money into such low-yielding fixed income products and ignoring dividend payers, which, of course, in equities are even more competitive than the yields that you're seeing. You're seeing no yield in fixed income. Is that a bubble?
I don't call it a bubble because it's not driven by huge animal spirits. They're not doing it to sell it at a huge profit. They're doing it because they were severely frightened in the Great Crunch. It was a devastating event, and it could have turned out much worse than it did. It should have frightened people. It did frighten people, and they'll stay frightened for quite a while. And what the Fed is trying to do is to make cash so ugly that it will force you to take it out and basically speculate. And in that, it's very successful, of course, with the hedge funds. They're out there speculating. Finally, the ordinary individuals are beginning to get so fed up with having no return on their cash that they're beginning to do a little bit more purchasing of equities. And that's what the Fed wants. It wants to have the stocks go up to make you feel a bit richer so that you'll spend a little more and give a short-term kick to the economy. But it's a pretty circular argument. For every dollar of wealth effect you get here, as stocks go from overpriced to worse, you will give back in a year or two. And you'll give it back like it happened in 08 at the very worst time. All of the kicker that Greenspan had engineered for the 02, 03, 04 recovery and so on was all given back with interest. The market overcorrected through fair value. The housing market that was a huge driver of economic strength and actually masked structural unemployment with all those extra unnecessary houses being built. All of that was given back similarly at the same time. It couldn't have been worse.
What are you expecting from the economy in 2011?
I'm expecting 2011, 2012, and 20 as far as I can see, to be less handsome than it used to be. I think we're on a trend line growth of about 2%, and I think we'll muddle through quite well. The problem is, in the not-too-distant future, stocks will be too expensive, and they'll crack again. Risky fixed income will be too expensive, and that will crack again. And unless we're lucky, we will have yet another crisis without being able to lower the rates, because they'll still be low, without being able to issue too much moral hazard promises from the Fed, because people will begin to find it pretty hollow. Cycle after cycle, the Fed is making basically, is flagging the same intention. Don't worry, guys, speculate, we'll help you if something goes wrong. And each time something does go wrong, and it gets more and more painful. And eventually, even fairly unintelligent investors might get the point that this is not a good game to play indefinitely. I am impressed, however, how eager we have been to return to the game. We got a practically mortal blow, and yet everyone was back in there swinging last year. It wasn't just that the S&P went up 80, which I did call, by the way. I said it would race up to 1,100. But it was speculative. So the junky part of the market went up 120%. This is a formidable recognition of what the Fed can do when it wants to.
What about the dollar? Where do you see it?
The dollar is on fundamental purchasing power. It's a fairly cheap currency. And as long as there's QE 3, 4, 5, and 6, you'd have to bet that it's more probable that it will go down. Now, if it stirs up a currency war, all bets are off. We haven't had one since the 1930s. Who knows how that will play out? That's one thing that can completely change the game. And very hard for me or anyone to guess what that would do. But if we avoid that, I think you have to count on the dollar being at least irregularly weaker until we finish the Q game, which is basically just running a printing press and using it to push down artificially the bond rates. And let me point out that the Fed's actions are taking money away from retirees. They're the guys and near retirees who want to park their money in something safe as they near retirement. And they're offered minus after inflation adjustment. There's no return at all. And where does that money go? It goes to reflate the banks so that they're well capitalized again, even though they were the people who exacerbated our problems. And hopefully the redeeming feature in that infamous trade is that you corporations go out there, borrow money, build factories, hire people, which they're not doing because consumption is weak and because they were also terrified by the crunch. I think, therefore, under these conditions, low rates is actually hurting the economy. It's taking more money away from people who would have spent it, retirees, than are being spent by passing it on to financial enterprises and being distributed as bonuses to people who are rich and therefore save more. So I think it's a bad idea at any time and a particularly bad idea now.
So final question here. What are you recommending institutional clients today? How should they be investing?
We recommend a very heavy overweighting in the great franchise companies, the Coca-Colas, Johnson & Johnsons. I'm not recommending those two names. They're just examples. We're recommending a modest overweight in emerging and underweight in everything else, extra cash reserves, and patience. But I think if you're willing to speculate, you might find that this is an interesting one more year to speculate. But be aware, the ice is thin, it's overpriced, it's a dangerous game. Don't believe that it's somehow justified. It is not justified by anything except the crazy behavior of the Fed.
You said the ice is thin. In terms of these cracks, how significant a crack would you expect when, in fact, we do see a crack?
The trouble with bubbles is when they go, it's very hard to know how painful it will be. But typically they go racing back to fair value. So if this market goes to 1,500 in a couple of years, by then fair value might be at 950. 950 is painfully below 1,500. And by the time it gets there, the mysteries of momentum in the market, everyone likes to go in the same direction when they shout fire. It's usually the case that it doesn't stop at fair value, 950, so it might go to 700. And you're talking another market that halves. It halved in 2000, and we thought it would, by the way. We predicted a 50% decline. It halved this time in 08, 09, and I think it might very well halve again if it